So my name is Gadoni Mwai, and it is a pleasure to welcome you all to this session that you've all been waiting for on the cost of capital. Today's session is not about financial metrics or ratios. Someone yesterday said, are you going to talk about CAPM? We're not going to talk about that. It's about redefining how we construct value and understanding who gets to define that. Kola mentioned correctly that we lose about $74 billion just because of the subjective credit ratings. So today we want to try and shift the narrative from a high-risk borrower to a high-opportunity partner in the world today. So we have three key leaders on stage today who are working at the forefront of this issue. We have Funke Okubadejo, who is a managing partner and CEO of Green Capital Management Nigeria, which is an Africa-focused real estate fund manager. She has 2 decades of private equity experience, having led investments of over $700 million. Please give her a round of applause. We have Victoria Sabula, who is the CEO of the Africa Enterprise Challenge Fund that has raised over $500 million in catalytic funding, having worked with 600 enterprises, and has managed to leverage an additional $900 million for these businesses. She's also Kenyan. So for the Kenyans in the room, we have David Van Dyke, who leads the Boost Africa initiative, which funds innovative African businesses and strengthens the continent's VC ecosystem. We called it yesterday the Fund of Funds. He also leads the Africa Venture Finance practice here at the Business School. Please give him a round of applause. All right. So I think I'll begin with you, Funke. You've raised institutional capital from pension funds. Could you please walk us through what investors look at when they calculate the cost of capital, and what usually is mispriced in that calculation?
Thank you, and it's really a pleasure to be here. I've had a fantastic time spending the day here, so thank you for the invitation. I think when you did share the topic, interesting enough, in 20 years, you really don't worry about cost of capital. We take the cost of capital which we are provided, and we try and work within that, which means that, obviously investors are looking at the risk-reward threshold in what you have, and then you look in a market and say, what are the risk-free rates in those markets, and you basically have to give them the market risk premium. But as I looked into the topic, it's just important to actually mention that a lot of the problem we do have of the high cost of capital is really embedded in the sovereign risk, which fund managers are not going to be dealing with on a day-to-day basis. This is something that has to happen in terms of a better understanding of the credit ratings that are being provided to the countries. We mentioned Africa. We've said there are different, obviously 54 countries, only 34 of which are rated. So there's basically lack of knowledge on the parts of the credit agencies, and there's just that idea of the mispriced risk. And then when we talk about the fact that there's no capital, or 1% of the capital, or 2% of the capital globally that's been invested locally, and then you bring in the fact that 74 billion is excess interest that is being paid by Africa governments, businesses, it's really something that I think in a hall like this we should pause and think about that. I think multilateral African institutions are looking at this to say, what can be done to basically improve on the understanding? African businesses are paying more, even though, as Kola illustrated, default risk for infrastructure is clearly at 1.7% versus 13%. Meanwhile, we still pay 200 basis points. So while on a day-to-day basis, nobody's worrying about this, we are having to price and look at expected returns to compensate for the market risk. But we should not forget this, and it is something that has to be dealt with. And the area of dealing with this is going to be in terms of data. capacity building. I think that was mentioned in earlier sessions today by governments to even know how to deal with the credit agencies to be able to bring this risk premium and this mispricing of risk. And really, what is this? It's the understanding of what the real risks there in terms of governance risk that you have in the respective markets, the regulatory risk that you have, how the economic reforms are being implemented, and also the underpricing of the upside. We all talk about the secular growth in Africa. So, putting that aside, that is one of the major risks you are dealing with. To say, you're expected to have 500 to 600 basis point risk premium when you do provide that. Yeah. I think in my experience, as we speak about the opportunities and the countries we're investing in, one of the first things is, I think it was also mentioned earlier, it's the rule of law. It's the enforceability of contracts. Those are things that can't be mispriced. You're also talking in terms of the standards and your ability to develop projects in a way or in an institutional manner, the governance in which you have there. So that's what fund managers, also founders, can speak to about their markets, to give confidence to investors in general about what they're doing.
Okay, thank you so much. You touch on mispricing and you touch on the risks that exist in the market. I know, David, you work with the VC funds, and so you have a view of this area. What do you think are the specific misconceptions that exist, and what can we do to, what has your work and your initiative done to make those better?
Thank you, and thanks again for having me. So maybe just to introduce who I am and what I do, kind of the signpost. Yep. So all my work is sort of early stage, which is angel investing up to and including sort of early stage VC. And on the latter part, I'm part of an initiative called Boost Africa, which is an initiative between the EIB, European Investment Bank, and the AFDB, the African Development Bank. I work on the side of the EIB, which is nothing but a fund of fund. So it invests into Africa-focused VC funds that invest in tech and tech-enabled companies. So it doesn't invest directly to companies, into VC funds. Funds like colas, unfortunately not colas, but funds like them. So in terms of risk, so obviously, so often when people sort of outside the continent speak about investing in Africa, it is about, to speak about investing as if it is a different planet, right? There's the rest of the world, and then there's Africa. Somehow the rules that apply in the rest of the world don't apply in Africa, which of course is ridiculous. And then of course, Africa is not a country, right? So obviously, a lot of things that kind of are clubbed together. So a challenge with depreciating currencies with the naira or different pound are taken for across the board, if you will. While if you're investing in West Africa, as Cola is also doing, obviously the franc CFA is back to the euro, so it's been a very different environment. So people are not granular enough when they speak about risk in Africa. Just to sort of to counter the point a little bit, because this is also be a platform for debate. So I think what Cola very clearly pointed out is that any question on risk for an investor goes hand in hand with a question on return. You cannot discuss the one without the other. And here, in that case of that early stage investing, so angel investing in VC, like Cola mentioned, it's a very new industry, new sector. So if we do not have enough track record on the return, if we don't know what the return is, it's hard to put a number on that risk. And then people being risk averse, they're going to sort of be overly cautious. So this discussion would be very different. And again, for that early stage piece, if there's more proven track record, if there's more proven returns, which is different like in the private equity, which is sort of a step up. There's much more data available. There's reports that show that across the board, funds in Africa perform at the same level at funds in Latin America. That data is not as much available for VC. So the sooner we can get sort of results in the books, the much more of a sophisticated discussion this will become. maybe I'll park it there.
Yes, and I think, Victoria, you've worked in this, especially with the SMEs directly. I just want to understand what, on top of the cost of capital and the perceived risk that David is referring to, there are some terms and conditions that exist for SMEs. For example, the collateral requirements. How do those affect the perceived risk of the SME?
Thank you, Gadoni. And may I just start by saying to the faculty and the students that you guys have done such a fantastic job. It's just... And it's really beautiful when you see an initiative that is truly student-led and you can be able to get through that through the days or, again, amazing conversations. So when you hear AECF, I just want you to remember that there are people who have to indeed prove that when you think about Africa, it's not just about a dare, that there is actually truth about investability, but there is a lot of work that goes into readying businesses for any type of capital. And even though I hear a lot about how expensive capital in Africa, having now worked with SMEs for the last very many years, we've worked with over 600 SMEs in 26 countries in Africa. I completely understand why a particular capital that has a particular fiduciary mandate cannot just be able to agree to go into a business that is, having to deal with inflations at crazy levels and just speaking about matters collateral as not everybody has land title. Not everybody has equipment and infrastructure that can very easily just be converted into an, maybe a specific debenture or whatever that looks like. And that is where we come in as the AECF. So we invest in high-risk, innovative businesses that are early stage, have potential for scale, but they struggle to access capital from financiers that are looking for traditional rates of return. We provide grants, yes, grants, match grants, interest-free loans, and debt. And you ask, but why would you do that? That is distorting. No. We level the playing field. We take the gem that is poised for greatness and we say, so you do not have collateral. No worries at all. You have an MVP. You have validated the early customers. You actually have a pathway to profitability. We will invest in you at 1.5 million and under, and we will get to walk the journey with you. And then over time, you actually get to have those assets that are actually needed to be able to broker a deal with a commercial financier. So we don't work at actually asking commercial banks to invest in SMEs at whatever level. We work to say, let's understand what commercial banks are looking at and other investors. And then we ready the businesses through provision of the instruments that I've talked about, but also embedding technical assistance, because a lot of things that we see is that it's not as much capital that is also missing in the continent as much as actually there's a lot of naivety on the part of businesses. They really cannot match the sophisticated requirements of it. They don't even know about financial models. You go talk to them about finance, and what is that? They don't have CFOs, they have accountants. So we get to have, the fractional experts that are available to these businesses to bring them to a level of sophistication that would then carry them on to unlock capital.
It's very interesting that you bring that up, because I think most of the time the story is around what can investors do, how can they identify the businesses, but I think also the businesses need to come up and work on that. What are some of the things that businesses in Africa need to do to be able to reach that level to be invested in?
I think one is really actually there's a real difference between early adopters and, having a proper, customer validation. So a lot of businesses, once you have 1,000 customers, 2,000 customer buying, say, but I have a great thing and nobody is hearing me. But what is it that will speak to repeat revenue? What is it that would speak to a very clear business model? Because that is what investors are going to be looking for. What does it look like for you to have a clear go-to-market strategy, distribution channels that are visible and bring credibility to whoever is bringing money, that actually their money is not going to get lost? But the other most important thing is talent. Who are is the investor coming to invest in. And that we go in at the AECF and we ask the hard questions. Why are you having your sister in the business? Why are you having your cousin in the business? And actually, why do you not have an independent board? 70% of the businesses that we invest in have never even thought that actually having a board is the right thing. They think that these are strangers who are coming to interfere with the plans that we have for ourselves. So having that conversation of why having a board is so important, and it speaks to readiness for an investor for the type of capital. You can't be looking for $5 million and you have never had another person look at your business with a lens of what is your capital stack? Why are we looking for equity and debt? You need that. So there is a lot of gaps, and hence a place of investments readiness for these businesses. The good thing is that they walk the journey, and I want you guys to look at YYTZ agro-processing in Tanzania, look at AfriFuta in Mozambique, look at Mountain Lion in Sierra Leone. M-Copper, actually, which was mentioned earlier by Abby, is a graduate of the AECF way back when PAYGO, nobody knew it. We actually thought, hey, prove it, scale it. It's now in over 33 markets, and we don't even know that one day it was just an asset. Did they know what they were doing? Not quite, but our capital was able to walk that early journey with them.
Thank you. Thank you so much for sharing. All right. Funke, you've mentioned about the institutional investors. Most of the time, institutional investors are perceived as conservative allocators of capital. What makes an African asset institutional grade for global institutional investors?
I think the point one of your earlier questions to me in preparation was, in looking at the institution, what do people worry about? The sovereign risk, convertibility, liquidity. Those are things that obviously makes investment opportunities institutional, and then how it's priced vis-a-vis the risk that that you're working on that investment. However, when you're looking at Africa, then the key points that I did mention is so important in terms of the enforceability, the title. I work on the real asset side, so you're looking at title, you're looking at stability of cash flows, you're looking at the risks that you actually are absorbing in terms of, do you have credit enhancements that supports the cash flows? Are you looking in terms of the quality of cash flows and the ratings of the counterparties that would also support this? So those are things that you would do. I think I'd also mention in terms of also the development process in here. I think we used to call it the disciplined development process. I think we've looked at it and said, what makes projects bankable? And so there's a discipline in terms of actually, designing projects, bringing the right level of competence throughout the life cycle of the project, and then you are absorbing the risk. I think one thing to mention about green capital and what we are actually focused on, we're looking more at the later stage stabilized real assets. So we're actually not taking on a lot of the development risk at green capital. But it's interesting because, if you are not taking a lot of risk, then the level of return that you are offering as a result is not similar to a development project, which we typically have about 20 plus in terms of IRR return to investors. But then, the big question is if you're in Africa and you're saying, I am not taking as much risk, and as a result, I should just be giving expected returns in the low teens. The key question for some investors is that Africa and low risk don't even go in the same equation. So once it's Africa, you're expecting a lot of return. So we have to spend the time to really educate investors in terms of how much risk we are actually taking on the investment and the level of risk that we offer. The level of return that we offer as a result. So I think that definitely is where we're going. I think one of the things also that we mentioned is, there's a lot of capital on the continent. I think bringing in investors on the continent is also a very important thing in terms of expanding. And I think that, for the risk appetite of investors on the continent does align quite well with what we're doing. So we've been spending time and fairly successfully in being able to bring in capital, but ultimately we do talk to investors on a global basis as well.
Okay, thank you for sharing. Kola mentioned about the fact that VC funding represents 1% of the global available VC funding, but Africa represents almost 20% of the global population. So, David, how has Boost Africa managed to close that gap? Because I know you do work with the different VC funds.
Right. So we do a lot of things, or within the program we do a lot of things. So on the investment side, this gets technical a little bit, but there is different instruments that are being used. So, for example, the EIB and other organizations do this similar. I speak about this program because I know most about it. So the EIB can come in with a first loss guarantee. They can come in with junior capital. Basically, it means that they lower the risk for other investors to join as well. And it's a very successful program, successful so far in attracting other DFIs. Less successful, you can argue, when attracting local capital, sort of private capital. But I mean, so there's financial instruments that are being used, which are really important. Another one is taking the role as anchor investor. So when a VC fund is fundraising, just like a company, right? If VC funds need investors into their companies, they're called LPs, limited partners. They need an anchor investor, the first one that comes in and helps sort of sets the rules for other investors. So, and then in this case, the EIB is very sort of eager or does not shy away from taking that role. And what that also does, it's sort of it's a stamp of approval. Like if an organization like the EIB, could be the IFC, if they invest in your fund, it shows that, hey, this fund passed through all the hoops that come through their due diligence. There's a conversation also about, to become investable, often, in this case, the EIB will work with a fund manager team to get to a certain level of, let's say, professionalism that they allow them to attract institutional capital. It's not always nice to get there, but once you get there, it opens more doors. And then Victoria mentioned technical assistance. So there's a separate budget outside the financial, sort of the investment capital, a separate budget to support the fund managers, also post-investment. That's a lot of work that I've been doing. So we support fund managers and their portfolio companies. And then just to bring it back to it says Africa Venture Finance Program behind my name. So one of the things that we did in this Boost Africa program is we designed, together with the Saïd Business School, we designed a program for VC fund managers. So for the past 4 years, we've brought 40 plus fund managers to Oxford for a week of peer learning, exposing them to the latest thinking on venture capital. Thomas Hellman, who was here, is the academic director. You know Thomas, so it's absolutely great program. Kola is an alumni from that program. So we run a program here, and which is, it works for a number of reasons, but specifically for the VC ecosystem. If you see a deal being announced, an investment being announced in the news, it is always a co-investment. It is investor A together with investor B together with C. It's that VC space, it's a space of collaboration. And then if you bring these fund managers to Oxford for a week, you're kind of stuck here in Oxford. You're too far from London to meet a friend or take a business meeting. You're stuck in Oxford. There's a lot of camaraderie that exists, that's being created in that week. And that automatically works. Next time you need someone, it's an easy phone call to make. So that's some of the things that we do in terms of supporting the ecosystem, trying to build an ecosystem.
All right, thank you. And back to you, Funke. How can we crowd in further local capital? Most of the time we focus on getting global capital in, but you have experience raising investments from local sources. How do we do that?
I think it's the patience. So initially, when there's a lot of global capital, I think most people didn't want to make the investment. Part of the investment is that you have to have locally regulated fund managers. And it took a while to even convince initially to set up this business. What we are finding out now that it's clear that there's capital. A number of the international firms are now all in the process of, making the investment to actually bring in the capital. I think, one of the things that we spent time was also trying to get DFIs to support some of these initiatives. The reason being, I think, as you mentioned, the stamp of approval of DFIs in a new fund manager or a new venture would be helpful to be able to bring it in. Our sense was that the mobilization of capital did not seem to have that much priority. The focus was more on the impact itself rather than the mobilization. A few of the DFIs were interested, but I think we could move forward because we had first mover advantage and was able to raise substantial capital. But my expectation is that there'll be more time being spent with the local fund managers. I think the initiatives that David have mentioned are also such that's been used in terms of, particularly for infrastructure financing, in terms of the development stage, first loss, some form of blended finance, which is helping to be able to raise and reduce the risk. I think in the morning we spoke a lot about insurances, credit enhancements. I think it's also the education on the government, also in terms of being able to provide guarantees as necessary based on the, particularly if you look at the energy space, being able to have, 20, 25-year contracts with government guarantees, as long as the services are provided, will be helpful. Yeah. And that's one of the things that you have. So as we said, the secular opportunities, if you have the different features that are there for an investor in the space, which gives you clarity on predictable cash flows, you will be able to get the finance that you need. So it's about working the opportunities. It's about also working on the fund and being able to mobilize capital. So we've taken the pain to mobilize capital locally, and we're seeing a lot more people doing the same.
Very interesting, thank you. Victoria, you've not only raised funding for the business from the AACF, but you've been able to catalyze private sector funding to the tune of 925 million. Could you walk us through how you do that?
Yeah, and a lot of times when people hear about AACF, they think that we are just in the business of offering grants to private sector businesses, but actually, our investment thesis is based on de-risking private investments, and our investors, who are public funders and philanthropic funders, hold us to account more on the leverage that comes into the businesses. And how we've done this really is, again, what I've mentioned before, which is taking the early market risk that commercial capital is unable to take. And I will give an example of YYTZ. Specifically, it's in the cashew value chain. It is, doing a turnover of $40,000 at the time, has a customer group that they're already working with in outgrower schemes, but they really have potential for scale, but their processing is very rudimentary, and they are unable to do even beyond, about maybe some few kgs. We help them to put up an ultra-modern processing facility of 2,500 tons, investing about $450,000. But even most importantly, after about a year, we invest in a traceability system. If you look at their website or their product, it's written there, fully traceable, which was able to open up the market, to open them up to international markets, improving the farmer yields. And they worked with the farmers to improve the yields, and then, the incomes were then better. But subsequent to that, about 2.5 years later, they actually got equity investments of $1.8 million. But if we did not put in that early $450,000, there is no way they were going to have a conversation institution, with an equity investor. The same thing with Kotor in Benin. They had, a proven model as far as last mile distributed energy, and we worked with them to bring in solar home systems into Burkina Faso, provided them 750K. About 3 years on, they actually raised debt and equity of about $8 million. And really that is the power of thinking about businesses who are early stage and have potential, and getting to support them to be able to move to that stage where their businesses get to grow on the basis of commercial capital. And I think that aligning the capital to the growth cycle of the business is most critical for all of us who are in the room. VC is very early in Africa. Where are, these businesses going to find the capital? PEs are looking for later stage, but how do businesses get to later stage? It is actually there being this catalytic funding that is going to crowd in the investors. And very quickly in Somalia, we've worked with microfinance institutions offering interest-free loans for them to extend their customer segment to women-owned and led micro and small businesses. We put in $2 million. They went on to put in their own $10 million, and we only had to cover with a guarantee of 30% on their own investment. Without that guarantee of 30% first loss, they would not have brought in their 10 million. But actually the call-up of that guarantee, believe it or not, was $66,000, which means there was already a bankable customer segment really in small and micro businesses that are owned by women. Nobody had worked with the financial institutions to create the products that are women-facing and really price the risk appropriately.
All right, thank you. And the last question from my end, I think, is for David. In a similar vein, how do we attract private capital to the VC funds, and how might we rethink shifting the risk-reward models for that?
Right. So that is sort of the million-dollar question, right? There's two million-dollar questions. One is how to attract private capital, and the other one is how to attract local capital. And like Kola pointed out in this presentation, there is still an over-dependency on foreign capital, over-dependency on development capital. And again, my world is that world of sort of angel investing VC, which is a relatively new sector, but we've simply not been successful in fixing that challenge. And it's a challenge because the development capital might not always be there. There's other ways, probably easier ways for development institutions, development banks to manage their development agenda, or there's other areas of the world that attract attention. So we've always been very mindful of trying to support local African DFIs, of fund investors. So for example, at the Africa Venture Finance Program, the program we do here in Oxford, we bring LPs, fund investors, one day in the week that think about the IFC and then all the European DFIs. Last year, we also had local African organizations. We had MS Meda, who is an Egyptian fund of fund. We had Anava, which is a Tunisian fund of fund. We had the PIC, which is a South African fund of fund. So there's definitely organizations like that that are more and more in existence. They used to be really focused on supporting their own ecosystem. MS Meda has supported each and every Egyptian VC fund. Now they also support regional funds, if you will. So there's definitely positive developments, but we need much, much, much more of that. And the industry, including myself, has not yet addressed that, been able to fix that problem. So I hope that more people in the room can able to come up with smart solutions.
All right, thank you so much for sharing. If you do want to reach out to them, I know we don't have time for questions, so if you do want to reach out to them, please feel free to speak to them when we are having our coffee break. All right, thank you all, and please appreciate it.